Hello, I trust that we are all well. So today's session is just a continuation of what we've been doing. Remember, we are looking at our revisions, and today's segment we are handling management accounting and advanced management accounting concepts. The question that I've shared here, this of course is from our block model paper. Remember, we have our block model paper 1 and block model paper 2, which will assist us, of course, at any given point in time whenever we want to prepare for this coming examination. So these are the questions guides which will assist us on areas that we need to be very good at before examinations. So of course, if at all you don't have this question, I'm going to attach our WhatsApp group link here below this video. You can just join the group, and that is where we normally tend to share, of course, these materials. So at this point, our focus is on this question that I've shared here. And what we are looking at on this case, we are looking at CVP analysis, a question of break-even point. So anytime you talk about break-even point, even before maybe we jump to this question, Mwalimu will want to remind us, of course, of these key concepts. But anytime you talk of a break-even point or the concept of CVP analysis, we normally tend to look at the main application of CVP being what? The break-even point. Remember, break-even point is the level of production where our revenue is equal to our total cost, or simply the level of production where our profit is equal to zero. So looking at this case, my good students, this should take us back to what we did, where we said we'll be talking about the break-even point for a single product and a break-even point for multiple products. You see, we normally tend to talk of a single product and a multiple product CVP. So these are the two forms of course, CVP that we'll always be talking about. So for single product, remember break-even point. In this case, we are familiar with in units, fixed cost we divide by contribution margin, or in value we normally tend to talk about fixed cost of CS ratio. Simply, you can take fixed cost of CM times, of course, your selling price. Now, when it comes to the multiple products, at this point, I should take you back to what we did. We say that anytime you talk about for multiple products, in this case, you must always remember about our formula being fixed cost. We divide by the weighted average contribution margin, that is summation, or you can take your fixed cost, we divide by summation of, this is what? Contribution margin ratio, CMR. See? So these are very important concepts that you must always tend to understand anytime you are dealing with multiple products. So our focus in the question, we are dealing with multiple products, and that is what I want us to look at. A very interesting question that I believe that after this bit, handling any question for CVP for multiple products, it will always be very easy. So I take you back to our question so that we go through it together. I believe the question shared is very visible. The question shared, I believe, is very visible. Let us go through this question and see what you're asked, so that once we handle it, all of us, we should be on the same page. So in this case, we're told that BB Limited sells two types of products branded D and A. The financial controller has prepared the following information based on the sales forecast for the period. The sales volume we are given. We are given unit selling price, unit variable cost, units contribution. We are given all these details, including the contribution to direct and contribution to direct and common fixed, direct avoidable fixed cost, operating profit, common indirect fixed cost, operating profit as well. In our question, my good students, our examiners told us that the common fixed costs relate, common fixed cost in this case relates to the cost of common facilities and can only be avoided if neither of the product is sold. The managing director is concerned that the sales may be less than the forecast and has requested information relating to the break-even point for the period. So required here, a good examiner has given us we are supposed to determine the break-even point of the two products in units and sales value if they are sold in the number one, original mix, number two, sales mix of 1:1. Highlight two advantages of break-even charts. So that is what a good examiner has asked us to do. So once you have that, so long as the formula is at the back of your mind, working out these questions will always be very easy. And the whole concept that Mwalimu had already shared with us earlier on, it will be very, very easy. Yeah. So these are what, of course, will be expected to do. Number one, it is important for us to understand the concept of mixed. Yeah. So anytime you to ask of the mix, that is to say, we are dealing with different products here. We are dealing, of course, with more than one product. So that in the combination of our production, we'll be having a portion of this and a portion of the other component. And if at all you can recall what Mwalimu guided us, at any given point in time, if at all you are supposed to determine the mix or the weight, given the fact that we know we are dealing with the aspect of multiple products, it is important for us, first of all, to indicate our formula that I know very well to determine a break-even point. Because it is multiple, I'll be talking of fixed cost over summation of weighted average contribution margin. Remember, we said that this weight will always be determined with the level of production that we do have. So the weight in this context is what we are looking at as the mix, where in this case, for us to produce this product, we required the two items that we were given, which in this case, of course, a good examiner had given us product B, and product A. Demand for the same, which will assist us to come up with a mix. Demand on this case, you're given, of course, the first case you can see, you're given a demand of 1200 for product D and 600 for product A. So with this demand level, it will help us to determine this component. It will help us to determine the mix, where up to this point we can agree, our mix we can agree, assuming we talk of for the ratio without considering our weights. Our ratio here, we are looking at ratio 1200 is to 600, meaning that if we break it further, we can now all agree that we're looking at ratio 2 is to 1. These are original mix. These are original mix as per the question. In terms of weight, we can all agree that this should give us, of course, 1800. So you take 1200 of 1800 to determine the proportion of that to our total, which would be 1200 divided by 1800. We're getting 0.7. Mwalimu is getting 0.7, meaning that the other one will be 0.3 automatically because it should give us 1. See, we're just dissecting it as slowly as that. So we can all agree that at this point you do have a ratio 2:1. When you are looking at the weights, then these are weights, okay? So once we have that in mind, then the things will be easy for us to proceed. We have to recall what Mwalimu guided us when you're looking at the weighted average contribution margin. So when you're looking at a weighted average contribution margin, therefore, in this case, I need to determine the summation of weighted average contribution margin. We have our D, we have our A. The question is, were we given contribution margin? That is what you need to identify. If at all you can go to our question, you can see we are given our items which led us to determine what? Which will lead us to determine the contribution margin. Where we are given number one, we have, of course, our selling price, and we have our variable cost, so that as at the end of the day, this will give us a contribution margin. Selling price, we were given for product A, we were given, of course, the value of 300. For product for product A, we were given a value of 200. Variable cost, we were given, of course, 150 and 110. So that our contribution margin, you can see, we have 150 here and we have 90 directly there, right? We were given directly. We could have taken it directly. And no one will ask Molimu, why could we have just taken the values directly? Yes, we could have taken the values directly. So, having that case, we need now to determine our weights. The weights already, my good friends, we have already determined our weights. Weight for D, 0.7. Weight for A, 0.3. So what is our weighted average contribution margin? That is my weight times our contribution margin. This, of course, will be easy because I'll be taking 150 for D times 0.7, which would give us, of course, 105. 90 by 0.3, which would give us 27. So that at the end of the day, we can talk of our summation of our weighted average contribution margin to be 132. So this is summation of our weighted average contribution margin we have at that point. We need to identify another variable, which is what? Our fixed cost. Were we given fixed cost somewhere? Identify if at all we are given our fixed costs. So our fixed cost, therefore, at this point, if you check our question clearly, my good students, we are told that our fixed cost we had, number one, we are told that the first component of fixed cost is what we are given there, direct avoidable fixed cost, which was 117,000. Direct avoidable fixed cost, we are given 117,000. Then we also given our common indirect fixed cost, which in this case you are given a value of 39,000. So what will be our total fixed cost? We have, of course, 117 plus 39, which will give us how much? 117 plus 39, it will give us 156. That's what Mwalimu is getting. 156,000. Okay. So once we have our fixed cost and we have our weighted average contribution, can we now determine this component? Can we now determine our break-even point? Yes, we can determine our break-even point. So therefore, break-even point in units for the two products, or rather for the whole company, of course, that is two products combined, I'll be having the fixed cost of 156,000. 156,000. We are going to divide this one by our weighted average contribution, which is 132, so that as at the end of the day, this will give us what? 156,000 divided by 132, which will give us 1182. 1182 units. So you're getting 1182 units. Of course, that is for the first case, okay? What about in value? How will we determine this in value? To determine in value, allow me to remove this portion so that now we can use the full board because we have everything now. So to determine in value, of course, these are what will be required to consider. We have two ways. The first way, in this case, we can have for each product, which I'll be having product D and product A. We take number one, our weights, which weights for each product we had 0.7 and 0.3. We multiply this one by, of course, our break-even point in units, one that we have achieved, which in this case you can see we have 1182. 1182 times 1182. That is a value, of course, that we've achieved as our break-even point in units. So therefore, in this case, to determine the break-even point in units, BP in units now for each product, BP in units for each product, we just take our weight, which is 0.7 times 1182 to give us 827 units. And the other one, we are going to take 0.3, of course, by 1182 to give us 355 units, okay? So that total should take us to 1182. What about in value? To determine break-even point in value, all you're going to do, we simply multiply by the selling price per unit. And the selling price per unit for each product, B, we had 300, and A, we had 200. So therefore, we take 827 by 300, whereas this one we multiply by 200. So that as at the end of the day, my good students, what will we be having? We'll be having 827 by 300 to give us 248, 100, and also we'll be having 355 by 200, which will give us 71,000. So in total, plus 248, 100, in total, we are getting 319, 100. 319,100. So that is one way that you can determine, of course, in value. For units, you could have just determined it in units like that, okay? And that is one way. The other way, which is also very easy, is that we have already determined our break-even point in quantity. So all we need to do is to determine, my good students, our weighted average selling price per unit. Weighted average selling price per unit. So weighted average selling price per unit, all we will be taking now in this case, I'll be taking our selling price of product D, which is 300. We multiply by the weight of D, which is 0.7. We add, of course, selling price of A, which is 200, times the weight of A, which is 0.3. So in this case, this will give us our weighted average selling price of how much? 300 by 0.7. Of course, you're going to add 200 by 0.3, which in this case should give us what? A value of 270. Should give us 270. 270. Okay? So break-even point in value for the two products, break-even point in value for the two products, we can take our break-even point in units times the weighted average contribution selling price, or rather the weighted average selling price. So by 1182, that is 1182 by 270, which would give us almost a similar value. Of course, because of rounding offs and the rest, you'll find that the variance is very minimal. 319, 140. See? So these are the two ways that you can always work it out. These are the two ways that you can always tend to work out your break-even point in value and, of course, the break-even point in quantity. So once you're through with that, the other part of the question, what were we asked? If I told you can check this other part of the question, and this one, I want you guys to do it on your own, where we're told now the sales mix, part 2 of the question, sales mix of 1:1. So the ratio is changing. The ratio is changing. Instead of us using this ratio, 2:1, we are asked, we need to determine the break-even point if our ratio changes into 1:1. If our ratio changes into 1:1, how will you go about it? This is to say that B and A, we have 1 and 1. Simply, in this case, our weight will represent 0.5, 0.5. So this will be our weights. So instead of using these weights, we use these weights. And that is what I need you guys to do, to determine for me in units and in value. That is upon you guys. Remember, our revision is on. If at all you will not join our revision classes, I don't know what you're waiting for. If at all you will not join our revision classes, I don't know what you're waiting for. Make sure that you get in touch on the number indicated below here so that we can guide you guys. To that point, thank you so much. Let us meet in our next segment, whereby we are going to handle another concept of CVP. Thank you so much, and let us meet in the next class. Bye-bye.